And thank you everyone for joining. So as Dan said with his very kind introduction, I've been working for JP Morgan on the emerging markets desk for over 15 years now. I sit alongside Austin Foray, the lead fund manager for JMG. And what I'd really like to do over the next 20 minutes or so is just walk you through 3 areas that I think are really worth considering when you try and appraise your need, I guess, for having asset allocation towards emerging markets. So if I could move over onto the next page, please, to look at the essentially my agenda. The first thing that I think is really important, I think Dan made some great points in his opening comments, are around time horizon. So when we think about emerging markets, and as we'll see with a couple of my slides, volatility is inherent. It's an asset class where they're called emerging for a reason, and as a result, you need to be able to be patient. You need to be long-term, and to my mind, you want to be thinking in years rather than months. Now, when we think about investing, again, as Dan pointed out by way of how you can invest in emerging markets, we very much fall into that second category, what we term active management. So rather than looking at the index as our start point is actually, where are the best companies? Where are the best businesses across emerging markets that have strong balance sheets, that have superior franchises and barriers to entry, and who are run by quality management, who we trust to do the right thing for minority investors? So our start point is very much on the ground by way of the best businesses. And then the final point, I think, is a really pertinent one. You probably all see a lot in various industry press around sustainability, ESG, and so on. This is something that we've always considered embedded in what we're trying to do. And the reason being, when you look for companies, you want companies that can keep doing the right thing. They're the businesses that tend to outperform over the long term and therefore deliver better financial outcomes. Now, there's various ways to think about sustainability. You can look at it by way of the carbon footprint and the environmental impact. You can look at it by way of how good is this company as a corporate citizen. And I'll highlight just a couple of ways that when we look at this investment trust, we can see that we clearly have a tilt towards sustainability and very much the ESG friendly side of things. So let's start off with a bit of detail about this long term. So what you can see here, 2 charts, let me walk you through them. But the key point very much is around it being multi-decade. To the point that Dan made, you need to be thinking long term about this. And that left-hand chart, what it's showing you is the GDP per capita on the y-axis, the vertical axis. So as individuals essentially have more money against their name, so they're getting richer. And along the bottom, along the horizontal, the x-axis, you can see the urbanization rate. So think of this as the percentage of people who are living in towns rather than countryside. And there's a very clear trend. You can almost see that you could draw what you could term a line of best fit from the bottom left to the top right. And you can see that the countries in purple are the developed markets. Think of that as the Western world. Emerging markets are barely getting started. What this chart is also showing is the sheer size behind that, because each of those bubbles is basically drawn to represent the size of the population. So you can see in the bottom left-hand side, India and China, 2 markets with over 1 billion individuals. So what we tend to see is as countries become more urbanized, as people move from the countryside to the city, a sort of Dick Whittington-esque, they start to earn more money. And that helps uplift the whole country. So this is clearly only just getting started in somewhere like India. And you can see on the right-hand side, when you project out where these numbers are going to go over the next couple of decades, it's going to keep growing. Now, over the slide, we can go into a bit more detail again on some of the GDP numbers, which you can see there on the left. Again, these markets are getting richer. But what I think is really important is, as much as we talk about China and India, and again, Dan gave some really good stats around the composition of the asset class, it's more than just that. We can find ideas and we can find growth coming from the likes of ASEAN, which you can see over the last decade has actually increased by 50% in relative terms its contribution to global consumption growth. Latin America is a great component, but understandably, it really is becoming all about China. And we'll see when we look at the portfolio and some of the ideas that essentially over the last 2 decades or so, the asset class has almost moved east, that Asia is now a far larger pool of opportunity than it was historically. If we think a bit nearer term, and again, just moving forward one slide, and think about what's happened over the last year and what's happened to our opportunity set. I think the beauty of this slide is a lot of this will resonate with all of you. The fact that all of our lives have not only changed through COVID, but many of our habits and our behaviours have also changed. And you can see here, when we think about consumer preferences, the fact that I guess the world has clearly become more digital. This event really highlights that. No longer are we all having to meet in the same big hall, sign in, grab a coffee, I get mic'd up and go on stage. We're doing this from the comfort of our own homes. We're finding that convenience has therefore improved. As people are sat at home, they want things quicker and more conveniently. When you think about it from a social standpoint, what you've very clearly seen is that the social interaction has become even more important. We can all think about businesses that we've been involved with through the last year and a half of the pandemic, where you think, actually, given a choice, I probably wouldn't spend money with them again. I don't think they've done X right. I don't think they've shone themselves in a great light. In contrast, there have been companies that have been hugely on the front foot. And again, I'll give some really good examples later of stocks in our portfolio that have done that. I think the other fallout is clearly healthcare. There's, especially if you think about emerging markets, there's historically been not necessarily an underinvestment, but less of an investment in healthcare than maybe you need today. So there's that big recognition, especially in somewhere like China, where they really recognize that they need to put their hand in their pocket in a far bigger way, both at a government and a personal level. And then finally, corporate behavior. And what you've seen is the good companies have continued to do well. The companies, as I said, that have the likes of robust balance sheets, that have quality management with a good business plan, that have had money put aside for a rainy day. And the last point I'll just highlight on this slide is that quote along the bottom, because this really ties into what we're trying to deliver with JMG. The wise only own ideas. What I mean by that is that when we look at the best companies nowadays, they tend to be fairly asset light. It's about being digital. It's about coming up with the ideas of and the systems of the consumers of tomorrow. What are people going to use? What are they going to be doing on their mobile phone? How are they going to be spending money? More so than emerging markets of old, which was very much about being asset heavy and capital intensive, commodities, where you had to pay a lot of money to get oil or iron ore out of the ground. And so when you think about this portfolio, think about it from the framework of we're trying to look forward. We're looking to the future, to where the emerging market consumers of tomorrow are going to choose to spend their money. Now, two other points that I just want to highlight from the long-term view is around the sheer volatility, but also the breadth of opportunity firstly. And that's what you see here. What this chart is showing, and I recognize there's a fair bit going on, so let me spend a second to explain it. Each of these bars is showing a particular market across emerging markets. On the far left-hand side is emerging markets overall in aggregate, and then we have the individual markets. The black diamond is the return in US dollars that market has delivered from the start of last year to the end of March, so the last 15 months. And the coloured portions show essentially what has driven the market. So the grey, as it shows on the right-hand side, is change in valuation, so the market re-rating. The purple is earnings growth, and so on. So I think there's 2 points that I would really highlight from this. Firstly, the sheer divergence of returns. When you look at just EM, you can see it's delivered 21%. When you drill down one level and look at it by market, it's delivered everything from 67 to what, minus 32. Nearly a 100% swing between the best and the worst market over the last year and a bit. If you were to go deeper and do that in each individual market and break it out by stock, you would get even more extreme. So to me, what this chart is really showing you is not just how EMs all work very differently. They're all at different stages of their business cycle. They have different drivers and catalysts around their market performance. They have different compositions of their markets, but you want to be active. You want to look at this chart and say, hang on, if I just bought the average, is that the right thing to do? Or do I want to be able to think, right, that country is doing well, so I'll have a bit more there. Or I know that in Taiwan, there's a lot in semiconductors and tech. That's tied in with a global recovery, so I want to go there. So I think what this chart is showing you is, as much as we talk about emerging markets as a block, strip beneath the surface, there's a huge opportunity for active managers where you've got large teams to go out and find the best companies. Now, the other point that I said I'd mention, which I think is really important to consider before you invest in EM, and again, this is something Dan mentioned, is volatility. Volatility is inherent in emerging markets. They're called emerging markets for a reason. When you think about the difference between EM and developed markets, it's simply a story of immaturity. Within emerging markets, you tend to get a higher degree of family ownership, of state involvement. You get historically greedy managers, corruption, so on, all of those negative stories you've heard. But what you do get is you get the opportunity to pick up better returns if you're patient. And what this chart is showing you is for each of the calendar years, going back to 1990, the red dot is the low point in the market. Okay, so if you look at 2020, you will see last year, the market at some point fell 34%. We all know when that was. That was towards the end of March, when everything looked horrific around COVID. The grey bar is where that asset class actually ended up that year. So through last year, if we use that as an example, the market fell as much as 34%. Yet if you held on to the end of December, you were actually 16% up from where you were at the start of the year. Now, if I look at JMG, so the Emerging Markets Investment Trust that we run at JP Morgan, those numbers are even more extreme. So from the 23rd of March, it fell to 73 pence. By July, it had rebounded exactly back to where it was in January. And from that low point in March, the share price is now double where it was. So the story is really one about patience. When it feels bad, think long term. It feels horrible at the time, but as this chart and previous performance shows, it's very much, as I said, about years rather than months. So let's start to think about the portfolio and what we're trying to do, what this portfolio can offer to investors. And I think the key point that I would start to make is that we are selective. As I said, it's all about going out and finding the best businesses. We have one of the largest teams in the industry, nearly 100 dedicated investment professionals who sit within our emerging markets group. They speak over 20 languages. So when we go out and we meet with management, we're doing it in mother tongue. We're ensuring that that lost in translation, where you get the wrong end of the stick, doesn't happen. And what we want to do is focus on companies that we believe can keep growing their market share over the long term. So rather than looking at a particular market or a particular sector, it's very much about the quality of the business. So these are just a handful of some of the companies that we added to or bought into through last year. B3 is a Brazilian listed stock exchange. Stock exchanges we actually really like. By nature, they're incredibly well regulated, they're asset light, and they're very cash flow generative. Whenever an equity or a debt or an FX transaction goes through the stock exchange, they get paid a fee for it. They're basically a facilitator. So what they really are is a technology company in a certain frame. But what it also allows you to do with the stock exchange is you're benefiting from the pickup in investment in that emerging market. We undoubtedly all have pensions that are primarily invested in the UK. If you think about emerging markets, those populations aren't really yet at the stage where they save money, let alone invest it in their domestic market, either through the likes of an ISA or from a pension. As that happens in time, it will clearly be really beneficial to these types of businesses. Bud Asia, as the name suggests, so the big beer and beverage brand who are starting to really gain market share in China, where Western brands are very sought after and people want to be drinking Western and developed market alcohol. Sea Limited is a great story. So this is actually the #1 e-commerce business in the ASEAN markets, so Southeast Asian markets. Think of it as almost the Alibaba or the Amazon of the ASEAN markets. And clearly you really benefited from what's been happening through COVID and that stay-at-home situation. WuXi Biologics is a Chinese listed healthcare company, and this is where I think we're starting to see a real pickup in the quality of the businesses coming out from China. It's actually now the 3rd largest biologics business globally, and what it does is it's essentially an outsourcer. So say you were a small pharmaceutical business and you developed a molecule, you probably wouldn't have either the expertise or the economies of scale to take it through testing, get it regulated, package it, manufacture it, market it, and so on. So what happens is you work with Wuxi Biologic, you essentially outsource to them, and they run a program called Follow the Molecule. So you go to them, you basically pay them a proportion of whatever you're bringing in. As a result of COVID, Wuxi Biologics have over $500 million pipeline. An awful lot of developed market businesses are wanting to outsource to Wuxi because they have shown themselves to be such a leader in this area. NetEase is a gaming company. I think that's a fairly straightforward story. And then KingMed Diagnostics is another Chinese healthcare company, but this time they're involved in diagnostic testing. So not just your likes of nowadays COVID testing, but blood tests, which historically a hospital would run and take ages. KingMed Diagnostics are really benefiting, as I said, from that pickup in healthcare demand, both on a private and a state level within China and Asia. Now, if I pull together how the portfolio looks from a country and a sector position, as I said, it is about individual stocks, but what I would say is we have almost a natural tilt or bias to certain areas, especially when you look from a sector breakdown. So what you see here is the bars, the coloured bars, show you whether we are overweight or underweight against the index. So that would be overweight or underweight against an ETF or a tracker, for example. And then the numbers along the bottom tell you the absolute exposure we have to that sector. So you can see that something like financials, the second one in on the left, we have nearly a quarter of the portfolio in financials. And what I've done is I've actually broken it down into the different subsectors, because when you look at financials, people often think, oh, that's just banks. And as I pointed out with stock exchanges, it's far more than that. Life insurance is a really great long-term theme for us to find. There's a very clear pattern or trend globally that when GDP per capita hits about $8,000, people start to take out insurance. And as many of us know, once you start to take out insurance across many areas of your life, you very rarely let it lapse. So it's a great long-term structural story. You can see technology is also around a quarter. That's a combination of both hardware and software. A lot of the likes of semiconductors, flat screen components, integrated circuit boards, everything that we're using more and more in daily life and sometimes not even realizing. Now, in contrast, if you look at the right-hand side of that top chart, you will see we have very little in materials and nothing in energy. And that's because, as I said, we want to be forward-looking, or we want to be buying companies that essentially we believe are in control of their own destiny. When you buy commodity companies, so energy and materials, the biggest driver of your return is actually the raw material price. And we would argue that our speciality, what we've all built our careers on, is the insight into emerging markets, rather than trying to guess the oil price or the copper price and so on. So that's a natural fallout. That's a very long-standing underweight. You should always expect this to be underweight commodities because it's just not the types of companies that we want to be holding over the long term. Now, by market, you can see here an awful lot of emerging markets listed, but it probably won't escape your notice on the far left-hand side that it says we have 9.5% in the US. Now, that's actually because the shares that we're holding are where they are listed in the US, but they are emerging market businesses. So just as many companies listed on the FTSE 100 are not directly related to the UK, it's exactly the same. So one of the businesses is originally an Argentinian business called Mercado Libre, which is like the Amazon of Latin America, the Amazon or the Alibaba. It's actually the market leader for e-commerce spending across 11 different Latin American markets. We also hold a Belarus listed business called EPAM Systems, who are an IT outsourcer and also involved in autonomous driving. The one other market that I will just highlight is India, that you see as the third name in. This is a market that to us really epitomizes that long-term potential. You saw on some of those charts how early stage the Indian story is. If I literally look at India by way of the demographics, they have nearly 500 million individuals under the age of 20. That's absolutely staggering. That's more than the working population in Europe. These are the sorts of individuals who will in the future live their lives through their smartphones. They will demand convenience, they'll demand choice, and therefore this to us gives a huge opportunity, as I said, over decades rather than years. So that hopefully gives you a flavour of what we're trying to do and where the portfolio tends to find a home. Last couple of minutes, I just want to touch on this sustainability standpoint, because I do think this is integral to why you want to invest in emerging markets from an active standpoint. When you think about emerging markets, one of the biggest issues I think investors have is that of trust. It's about the fact that when was the last time you read a headline in a paper about emerging markets that wasn't negative? That you read about the volatility, you read about the corruption. Any of those things, to be honest, happen in any market across the world. But what we want to do is, in thinking about how carefully we invest client money, we want to be very thorough and very diligent about finding the best businesses. So one of the things that we use is what we term a materiality framework. And essentially, this is just becoming even more detailed. It's going even deeper into our understanding. And put quite simply, we split the universe into a lot of smaller groups so that we can really compare like with like. Rather than looking at all financials together, we look at stock exchanges, insurance companies, brokerage firms, and so on. And it allows us to essentially peer rank the businesses to understand who we think is the best in class. What it also does, as that final box suggests, is when we engage with management, and as I said, we do thousands of meetings a year, we can go in and ask those pertinent questions that we believe are really crucial to understand that business and its ability to succeed. So one of the questions that we think about with e-commerce is how well does that company restrict the sale of counterfeit and fake goods on their marketplace? It's all about thinking, what's going to stop this company doing well in the future? Likewise, when we look at businesses, if they look like they're making too much money, which sounds like a really crazy thing to say, we think, hang on, that's not right. Because guess what? Everyone can make a lot of money if they cut their marketing budget for a year. But guess what? The year after next, you're not going to have as much business because you've not been promoting yourself to new customers. So it's about recognizing how all of these businesses are reacting and acting in a sustainable fashion, and therefore giving us that long-term opportunity. Now, I mentioned how there are several metrics and things that we can point to that highlight how the trust looks against certain sustainability factors. First one, carbon footprint. If I draw your attention to that blue column, the second in from the left, you can see that the carbon emissions of the portfolio are less than 10%, in fact, less than 5% of the universe. This just shows how asset-light the businesses are that we're holding, how they really are the businesses that are running themselves in a far more sustainable fashion. The other metric that I think is quite useful over the page is just an example of some of the stocks that we hold in the trust that have performed not only performed well through COVID, but have really stepped forward. And in many cases, I think this is a surprise to investors who, when they think about emerging markets, they don't think about corporates thinking broadly. But what you actually saw through the last year and a bit is that the S of ESG, so you have your environmental, your social, your governance, that social side has always been a bit fluffier. No one's quite known how to define it, because when it's environmental, it's factors such as the carbon footprint. When it's governance, it's about trust, it's about dividends. What does the S mean? And what we've seen, and I won't go through this because I know you're going to have the slides at a later date, is a lot of our businesses have shown themselves to be really good corporate citizens. Yum China has donated meals to community hospitals. Walmex in Mexico actually shortened its payment times to keep smaller micro suppliers liquid. So rather than paying people as normal every 30 days, they brought it into 7 days. They recognized they had a responsibility as a large corporate to do the right thing. And I think what's great about this is it highlights the maturing that's coming through from a lot of management in emerging markets. The recognition that at times you have to take a step back and do the right thing in order to build your brand, to build loyalty, and ultimately to give better financial outcomes. So when we think about outcomes, I think the performance page that you see here really speaks for itself. We would always encourage you to look at performance over the longer term because that's what we're trying to do. We recognize there is short-term volatility. There are going to be times that we drop a couple of % in a month, but likewise we pick up a couple of % in a month against the index. But when you look at that 3, 5, 7, 10-year number and the excess return, so how much we've beaten the index by, it really highlights the benefit of being an active manager and being able to essentially select between the winners and the losers. So what do I want to leave you with? Well, actually, it's just a picture. And the reason being is, what do I want you to think about with emerging markets? Why is this a part of the world where most people are underweight that I don't think you should be? And it's because of this. 80% of the world's consumers live and work in emerging markets. These individuals over time, as we saw from some of those charts, are having more money in their back pocket, more money to spend, more choices that they're going to make. I mentioned how there are over or nearly 500 million millennials in India. In China, there's another 400 million. There is a huge demographic wave coming through of individuals with more money to spend. So yes, as Dan pointed out, you will have risks. Volatility is inherent. They're called emerging markets because they're not the finished article yet, but these are also the markets of tomorrow. So when you think about the title of the presentation, as Dan gave, how to invest in emerging markets, I would argue that you want to do it with patience, with a long-term view, and also with an active manager that allows you to differentiate between the winners and losers and really find those big champions of tomorrow.